Live, we trade the market, and so Tony Zhang, chief strategist, options play, is with us, feeling like it could be a little bit bearish right now. You are seeing risks. You're acknowledging some of those. Good morning to you, Tony. Great to see you. Some of the risks that are grabbing your attention right now.
Yeah, Nicole, a couple of weeks ago when I was down on the floor, you asked me some of the concerns that I had with the markets. And at the time I answered, the biggest concern that I have here is with the Treasury market. And since then, we've seen the Moody's downgrade of US debt, which triggered some angst with regards to the safety of US Treasuries. And then yesterday's poor Treasury auction, which was the stark reminder, if you will, of these looming risks. Yesterday's auction obviously was the catalyst of a small pullback here that we saw yesterday. It also showed us, some of the signs of the lack of liquidity that we see here in the overall U.S. markets. But the debt pile continues to grow. We don't particularly have a clear path as to how we reduce that debt pile. And we saw yields surge here yesterday, 20 and 30-year yields above 5%. The 10-year yields, I'm targeting around 4.8% here to the upside. We continue to see bonds sell off here today, even though equity markets have stabilized a little bit here at the open. I was a little surprised that the equity market was able to shake off the downgrade on Monday morning. We basically opened up down about 1% on Monday. By the time we finished the session, we were up on the day. But, at the moment where I actually see the biggest dislocation right now is in the options market. With the VIX still hovering around that 20% level, it really shows that equity investors are not particularly concerned about bigger downside risks. And clearly, in my opinion, those risks are there, and we're seeing that emerge more and more so at a more frequent basis over the last few weeks. So I think there are opportunities to potentially take advantage of this mispricing of the downside risk by buying shorter dated SPY put spreads. And this really is not necessarily an outright bearish view. This is simply as a way to protect, equity portfolios, because I think a lot of viewers here probably have long equity positions that arguably they want to stay in those positions. They don't necessarily want to move out of those positions, yet this is a way that they can remain invested, potentially capture that upside while having some downside protection. Now, this is very short dated downside protection. I'm only going out to the May 30th expiration, because at the moment, I don't necessarily see this as a huge systemic risk. I do think that in the short run, there is some mispricing of downside risk. So I'm going out to the May 30th expiration. I'm looking at buying the 575, 565 put spread. So these are put spreads that are way out of the money relative to where we are trading right now. But that put spread's only trading for about $2. And that means that if a $10 wide put spread like this trades for $2, that gives me about a 4-to-1 risk to reward ratio if SPY pulls back to below that 565 lower strike price. It's a bit away from where we are trading right now, in a little over a week. But, we saw that, we saw the S&P lose 80 handles yesterday intraday in a very quick succession. So, to lose another 150 handles is not that out of the question here for another week going out a little over a week. And that's really where I think there's some opportunity here right now for investors to take advantage of the relatively low implied volatility that we still see, despite the volatility that we actually have seen this week.
They always say watch the bond market more than the equity market to really know what's going on. And the bond market is certainly putting out some red flags, some caution tones, etc. And to your point, the equity market just seems to be shrugging it all off, shrugging off Moody's call, but that joins Fitch and S&P with the ratings and lowering the U.S. one notch. At this point now, when I had asked you about it's going back down, you had told me, like you thought that was a possibility. I remember our conversation here. You were on point with that, talking about that. And not likely to see the new highs again for the S&P, more likely to retest those lows?
Yeah, exactly. We'll see where the S&P ends up this week. I think that if we can get back above 5,900 on the S&P 500, that would be a bit more positive here for equity investors, and have it retest those all-time highs on the S&P 500. But if we close below 5,900 this week, I do see some further downside risk. I don't see much support here until 5,350 on the S&P 500. So there's quite a bit of downside that we can potentially test. Like I said, I don't particularly think that the news that we see here right now justifies kind of looking at a bigger correction here in the broader markets, but at least a short-term pullback after what has been, a very strong run off of that August lows. We're looking at about 23% rally here on the S&P 500 over the last 4 or 5 weeks, and we're really looking for potentially a bit of a consolidation and perhaps a little bit of a pullback here. And this way, equity investors who are invested that are concerned about some downside can get that downside protection, but still remain invested.
The tax and spending bill seems to be going through. I mean, that will continue to add to U.S. debt. Depends on the scoring. If you look at the CBO, they said maybe $2 billion over 10 years. The CRFB says maybe double that. It's hard to know, but it will contribute to the U.S. debt. Is the one big beautiful bill, could it have upside though with tax cuts and maybe promote growth? I don't know, but what do you think? Because right now it's passed through the House, it's heading to the Senate. Thoughts on the bill and what it means for investors?
Yeah, I mean, investors clearly are taking this as a positive here overall. Looking at the stability of the equity markets here today, as you said, it's passed the House. We do expect that there's going to be some changes, as it goes through the Senate. So, that's really something that like you said, it is still going to add to the deficit. It's still going to add to the debt pile here, not by much, but it is going to, and that is still a concern. So that's what I mean in terms of what I said, that there isn't a clear path as to how we get out of this debt pile that we currently have continued to amass, and that is why we continue to see bonds sell off here today and not stabilize the way that equities have.
Understood. A final quick thought here. I mean, sometimes people ask me about the Mag 7. I mean, folks get excited. They want tech to take off again. They think AI is in a revolution. There's so many things that are happening and growing and changing. Is there hope for some of those to be some of our catalysts?
Absolutely. I still, if you look at NVIDIA trading still around 25, 26 times forward earnings, I think is one of the most undervalued stocks here in the broader markets. And you look at kind of what opportunities there are with AI, that is the one kind of a black swan on the other way, if you will, that could potentially kind of lift all of this, lift us out of this to some degree. Is that just growth out? There's so much growth here from tech that it sort of kind of uh, what's the right word? Negates kind of the debt pile to some degree. That meaning, if we continue to see strong exponential growth here from technologies like AI, so I definitely think within the Max 7 there are winners and losers. For example, Nvidia, I think trading at 25 times forward earnings is one of the most undervalued stocks right now. But looking at stocks like Apple trading at nearly 30 times forward earnings, I think those are ones that I would stay away from. So I think within the Max 7, there definitely are winners versus losers.
Understood. Tony Zhang, great to see you. Chief Strategist, Options Play. Tony, thanks so much.